Good evening, class. And how have you guys been today? I'm sure you have had a very busy day since morning from one class to the other. Today, we are going to be moving forward on IAS 16. If possible, round it up if we can. That's the objective today. So far, for this class, from what I can see here on PPE, I know we have looked at definitions. I know we have looked at recognition. I know we have looked at subsequent cost. I know we have looked at measurement. So we just need to round up a few things on measurement today. Then I go to the recognition and disclosures very quickly. Then we'll start solving questions, right? Let's see how many questions we can solve today. If we can't finish solving everything today, we can always continue solving next week. So we defined PPE as any tangible asset or any tangible item that is held for use in the production or supply of goods or services, rentals to others, and for administrative purposes. And it is expected to be used for more than 1 year. And we said you can recognize PPE in your books when two criteria are met. Number one, if it is probable that future economic benefits associated with the item will flow to the entity, and it must have a cost that can be measured reliably. When you have PPE that you want to recognize, you simply debit that PPE and credit bank or credit other payables if you are buying it on credit. When you have recognized your PPE, you need to measure it. They are initially measured at costs. And cost comprises of purchase price plus import duties, plus non-refundable purchase taxes, less trade discounts and rebates. Then you have any directly attributable costs. You had that. If you had initial estimate of dismantling, removal, and restoring the site on which the asset was initially located, that is also added. And if there are any borrowing costs are also added. I mean, borrowing costs relating to qualifying assets. We said they are also added to the costs of an item of PPE. Then I went to subsequent costs. I told you that after the asset is ready for use, then you will still incur some costs going forward while you are using the assets. We said those ones are subsequent costs. And I said that there are some subsequent costs that we expense, like repairs and maintenance, and simply because they don't meet recognition criteria as an asset, we cannot capitalize them because they don't create new benefits. They always ensure you achieve your initial lifespan of the asset. So any subsequent costs that will be capitalized must be the one that will increase the productive capacity of the asset or will increase the useful life of the asset. These are subsequent costs that we can capitalize. Then we move on to subsequent measurement, which is the measurement at the end of the year. And I told you that for subsequent measurement or measurement at the end of the year, we use two models to do that. We have cost model, we have revaluation model. And I told you that these two models, both cost model and evaluation model, they both will help us determine the carrying amount of the assets. So the two of them will determine the carrying amount of our assets. So for the cost model, I told you it's basically cost minus accumulated depreciation minus accumulated impairment losses will give us carrying amount under cost model. And under evaluation model is fair value or revalued amount minus subsequent accumulated depreciation minus accumulated impairment losses. That will also give us carrying amount under revaluation model. You see, each of these models, you're free to choose, however, the one you want to choose. Just that if an entity choose revaluation model, it requires so much effort from them because they will need to be revaluing the asset. And accountants are not really trained in valuing assets. They probably will need to get a valuer to come and value the building or the plants, whichever PPE they want to value, and they will spend more money. Of course, the advantage is that your book value, your carrying amount becomes more realistic because you'll be carrying a more recent value. Now, cost model evaluation model, there's depreciation that is very important for the two of them. I also explained that to you, that depreciation is not reduction in the value of an asset. Depreciation is not loss in the value of an asset. Depreciation is not setting money aside to replace an asset. Those are misconceptions around depreciation. Depreciation is really a systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. The systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. So depreciation really, from that definition, I told you last week that is majorly helping to comply with accrual concepts and matching concepts, saying that when you buy an asset that you're supposed to use for 5 years, what we do in accounting is to spread that cost over 5 years. Okay, you spread that cost over 5 years. And that's where accounting works. Anytime you incur a cost and that cost, you enjoy benefit from it for many years, you're expected to spread the cost. Even rent, if you pay rent for 5 years, you can pay 5 years rent, you can pay 2 years rent. In P&L, you will not just go and dump the entire rent you have paid for the entire period in P&L. We don't do that. You only recognize 1 year. The others you prepay. You call it prepayment. Okay? But here, for PPE, when you buy an asset that would be beneficial to you for like 5 years, you will get 1 year portion of that cost. You call it depreciation. The remaining, you call it carrying amount. Unlike the rent scenario, the first year they call it rent, the remaining they call it prepayment. It's just the same thing. All is complying with accrual and matching concept. So that is what depreciation is all about. It's really nothing serious. As a reporting student, don't see it as reduction in value. It doesn't represent reduction in value at all. It's far from it. It's just getting how much we recognize as expense this year, how much you recognize this year. That's depreciation. And we really clarify that. And we said to do that, we use either straight line method or reducing balance method. And I showed you the formula for straight line, which is cost minus residual value over estimated useful life. And I explained why we are removing residual value, because basically we are not using that portion of the cost. Residual value is the value at the end of its useful life. So what we really want to depreciate or allocate over its estimated useful life is the depreciable amount. So whenever we have residual value, then our depreciable amount becomes cost minus residual value. That is what we want to allocate over its estimated useful life. And for straight line also, they could give you depreciation rates. If they give you depreciation rates, in that wise, you need to apply the depreciation rate on the depreciable amounts to determine your depreciation per annum. The thing about straight line method is that it gives you the same amount of depreciation every year, okay? And typically, straight line method is used where the asset generates equal amount of benefit every year. I mean, it makes sense that way, so that you're matching like. So if the asset is generating equal amount every year, it makes sense to spread the cost to equally every year, matching concept, right? So that's straight line method. Reducing balance method is basically, they would always give you a depreciation rate, which you are going to apply on the carrying amount, just so that the depreciation you compute aligns with the name of that method, reducing balance. So we really expect the balance to be reducing, and also the depreciation every year to be reducing balance, right? So which is why the depreciation is computed on a reduced balance, on a reduced carrying amount, right? So that's reducing balance method majorly. Okay, and very importantly, I mentioned something to you that you see in determining carrying amount, that formula cost minus accumulated depreciation minus that is determined in the fixed asset schedule in the notes. Okay, so that model, cost model and evaluation model, that cost minus accumulated, they are separate accounts. What you find in your asset account is cost. Then there's another account called accumulated depreciation. Okay. And that shows when I asked you the journal entry for depreciation, somebody said debit P&L, credit asset. I said, no, you're making the same mistake. You don't credit asset with depreciation. Depreciation don't go to asset account. Asset account is always at cost if you are using cost model, and it is always at fair value if you are using evaluation model. So when you have depreciation, when you debit P&L, you're actually going to credit accumulated depreciation account. You credit an accumulated depreciation, which you are ultimately going to take to the fixed asset schedule to net off against the cost. Then the carrying amount, you take it to the statement of financial position. I gave you some hypothetical examples. I was showing you all of these last week. Now, even last week, we moved forward on revaluation. Okay, I told you that when an entity is using a revaluation model, the first thing I told you is this: see, this model, they are selected on a class by class basis. If you have buildings and you choose, let's say, evaluation model for a building, you see, all the buildings you have within that entity, you must use evaluation model. You cannot use evaluation model for building A and use cost model for building B. No, it's class by class. However, you can use evaluation model for buildings that you have and use cost model for all your motor vehicle. It's okay. It's okay that way. I mean, I need you to note that down. Then I went deep into evaluation. Okay. I told you that when an entity chooses a revaluation model, it goes to show that they need to be revaluing their asset at the end of every year. And doing that will result in evaluation surplus or evaluation deficits. Okay. When you have that, in determining that surplus or deficit, is just comparing the fair value with the carrying amount. That gives you whether you're having deficit or surplus. So anytime you're told in a question that the company revalued its assets, then you need to know, okay, when did they revalue? At that date, you need to calculate revaluation deficit or surplus. When you have a surplus, which means that the fair value is higher than the carrying amount, which means that you're having a gain, that surplus is taken to OCI. Taken to OCI because that gain is an unrealized gain. It's not a gain you want to celebrate yet. I mean, it's just an economic gain. It's not a real gain. So you take it to OCI as a reserve. So from OCI, it ends up in equity as a revaluation reserve. So we are keeping it until we eventually sell the assets. Okay, that is when we can celebrate the gain and say, okay, we have actually made a gain. Then we can then take it to P&L or retain earnings and say, okay, it is now a gain. But for now, it's a reserve. And that is why evaluation surplus goes to OCI. From OCI, we take it to evaluation reserve through our statement of changes in equity. You will see all of that today. However, I told you that if on the same asset, there was a previous evaluation deficit on the same asset, because of that previous deficit, then instead of taking surplus to OCI, you need to go and net off the previous deficit first. So you take it to P&L. So is any excess you can then take to OCI. We explained that last week. So you can take surplus to POL to the extent of previous deficit. The same thing applies to when you have a evaluation deficit. Evaluation deficit are losses. So in your reporting, we really would not say, okay, this is unrealized loss. We take losses to P&L. Let it sit in P&L. However, losses can be taken to OCI to the extent of the previous surplus. So if you have a previous surplus on that same asset, okay, previous surplus, you now have a deficit this year, you can take that surplus to OCI. Then if there's any excess, you can take that to P&L. So basically, that was what I've discussed so far. And I gave you assignments, right? Some of you did it, most of you did not, which is of course very bad. So now, these are the assignments that I gave you. I said assignment 1, determine the journal entry of the revaluation surplus here. So we had the revaluation surplus of 50,000, and this is the journal entry. So let's say this is debit, let's say this is credit. First, you see, this revaluation surplus, the first thing that should come to your mind is this. We have a surplus, and a surplus would definitely increase our asset. However, we will need to look at what is in our asset account before. Our asset account was carrying 150. What is the new value now? What is the new value of our asset now? The new value of our asset is 170. And this is where most of you did not get it right, because you were debiting assets with 50,000, thinking because because we made a surplus, then let's debit our asset with 50. That would be wrong. If you debit your asset with 50, remember, I told you that what is in your asset account is the cost. Is the cost. That's what is in the asset account. So you want your asset to move up from 150 to 170. So there is no possible way where you can debit it with the entire surplus. That will be wrong. So first, for the asset to move on from 150, which is the cost, to 170, which is the new value. That means you need to increase your asset value by how much? By 20,000. Always resolve this first. That naturally, what will go into my asset account is 20,000. In this case, of course, is going up from 150 to 170. That's just increase of 20. After I've resolved my asset account, then you can then deal with the revaluation surplus. You can then deal with the revaluation surplus that goes to your OCI. Is a surplus, so you credit it, right? You credit it. Looking at this, my account is not balancing. I have 20 debit, I have credit 50. What's happening? What's happening is that, you see, this accumulated depreciation account on this asset, will be cancelled out. And accumulated depreciation is a credit balance. We need to cancel it out. We need to start over again. You see, when you revalue an asset, from the date of revaluation, it's like the asset is starting over again. Depreciation is starting over again on this asset. When you're depreciating, you are depreciating over the remaining useful life. And everything is starting over for the asset. So you see, the accumulated depreciation till the date of revaluation will be cancelled out, will be eliminated. And accumulated depreciation is a credit entry. If you need to cancel it, what do? You debit. Your account is balanced. Okay, this is what you would have done. This is what you would have done if the examiner happened to ask you journal entry. If they don't ask you, don't bother. Just take this one to OCI and just be looking. And this is the new value of your asset. That's scenario 1. Now, scenario 2, let me bring it down. Scenario 2, this same asset, I gave you this question. There was a previous surplus, divided amount. in this question, we had a deficit of 5,000. And it said the evaluation will be recognized to OCI because we had a previous surplus, right? Okay. So I said determine the journal entry. Debit, credit. My first mission is my asset value before was 50. Now the new value is 180. The value has gone down, obviously. So I need to bring down the asset account from 230 to 180. I need to bring it down from that. So my asset account, if I want to reduce the value of my asset, what do? I debit it by 50,000, right? Because it's coming down from 230 to 180. So I credit it by 50,000. That's the first thing I deal with. The second thing is I need to really clear up this revaluation deficit, but because there was a previous surplus, so this deficit will go to my POL. This deficit will go to my POL as a debit of 5,000. Is it POL or OCI? It will go to OCI since there was a previous surplus. Since there was a previous surplus, the same asset. So this deficit has to go to OCI first. I debit it. So my account is not balanced. I mean, debits, credits, I mean, they're not balancing out. And that's because this accumulated depreciation needs to be cancelled out. So accumulated depreciation, you debit it to cancel it out, then we have a balanced account. Now, you see, you need to understand this, even though they don't often ask it in the exam, these journal entries, you need to understand this double entry this way, just so that this thing can make sense to you. This revaluation model that I said fair value minus subsequent accumulated depreciation. You see, this subsequent accumulated depreciation is showing that I'm starting depreciation over again from the date of evaluation. That's why they say subsequent. So, which means that all the prior depreciation will have been cancelled out. You will see under the cost model, we didn't have anything like that. There was nothing like subsequent accumulated depreciation. It was just cost minus accumulated depreciation straight on. Unlike fair value revaluation model, is fair value minus subsequent accumulated depreciation. Okay. So that's solution to the assignment. Okay. Latif, please go ahead. Make it very sharp. We have a long way to go today.
Thank you so much, sir. Sir, please help us just extract this correction and let us have it separately, please. Assignment. Correction to the assignment. Let us have it separately, sir.
Okay, noted. Noted. I'll do that. Okay. There's still a lot you will have to learn around this. There's really still a lot. Let me mention something very briefly, even though it's not really, it's not that. Let me mention two things. Number one, who can tell me when does depreciation on an asset commence? When do you start depreciating an asset? Anyone have an idea?
As soon as the asset is ready for use.
Okay, thank you very much. That's absolutely correct. Note that depreciation commences when the asset is ready for use, not when the asset is actually being used. So an asset can be ready for use in 2010 and you're not using it after 5 years. You depreciate even if you're not using it. Okay, so as soon as it's ready for use, depreciation commences. Okay, that's important for you to note. Now, I needed to mention something. There's something we call excess depreciation. Before, if I don't teach it today, remind me for me to teach it. It's optional, but I just need you to know it. I would come back at it. I don't want to teach it now. It won't make so much sense for you. Let me solve some questions, then you would be able to relate with it properly. Then the final thing I need to mention is the recognition of PPE. Now, the recognition is the opposite of recognition. It's just the opposite of it. And recognition is like removal from your books. And you can remove an asset from your book typically when you have disposed it, when you have sold the asset. Then you can go ahead to remove it. So how do you remove asset from your books in terms of accounting? Basically, when you remove an asset from your book, you are definitely going to record a gain or loss on disposal of that asset in your books. A gain or loss on disposal. And the way that is determined is by comparing the sales proceeds on that asset with the book value or carrying amount of that asset. Then, whatever you get here will become a gain or loss on disposal. Of course, it's a gain when the sales proceeds is higher, it's a loss when the sales proceeds is lower. But if I may ask, where do you think this gain or loss on disposal should you go to P&L or OCI? Who can help?
OCI.
OCI, right?
OCI.
Why is it going to OCI?
Because it's not the ordinary activities of the company.
No. No. That's not why. The one I've mentioned, the one I've only taught you that goes to OCI in this class is revaluation surplus. And the reason I mentioned that it goes to OCI, I didn't mention because it's not the ordinary. That's not the reason why items goes to OCI. It's basically because it's an unrealized income. That's for the revaluation surplus. It's not a real gain. It's just a book gain. Okay, so it's not a gain we are proud of. It's not a gain we want to celebrate yet because we have not actually earned it. It's an unearned income. It's an unrealized income. And that's why evaluation surplus goes to OCI. So when you tell me that gain or loss goes to, on disposal of an asset goes to OCI, I mean, I'm very curious to know why, but not because it's not the direct line of business. Any other trial? If you still insist that I should go to OCI, I need to know why. Anybody?
So I think you should go to POL.
Why?
Because for us to dispose an asset, we are making gain or loss. We are having the we've already gained either the value. So it's not really that we are looking forward for it.
Good. You're absolutely correct. You should go to POL. It's a realized gain. We have realized it. Okay? I mean, it's of course going to be as part of your other operating income. Okay? Just like what the other guy was trying to say, it's not a major line of business, so we can't recognize it as revenue. Is income or gross inflow from a major line of business that goes to revenue. Other income we put it as other operating income. So absolutely correct. Whether gain or losses, it goes to POL. Okay, Latif, you have your answer. Issues?
Yes, sir. I also want to add to it, sir.
Okay.
That it has to be debited to POL so that we can have our gain on the remaining useful life that we sold out and to end the excess to end the revaluation surplus on it as well.
Okay.
This is an asset that has been revalued before.
Okay. All right. Okay. Okay, but no, right? So if it's a gain, it's an income. So it's like crediting P&L, right? I mean, it's an income. So it's not like debit P&L. So if it's a loss, it's an expense. You can mix it up with your administrative expenses. It's an expense if it's a loss. Okay. Where you're going is this. When you sell an asset that we had revalued before, remember that when you revalue, you have a evaluation surplus. I told you that evaluation surplus is unrealized, so it goes to reserve. But you see, by the time you then sell the assets, that means the evaluation surplus that we said was unrealized now becomes realized. It becomes realized. So when you sell an asset, when an item of PPE is disposed, the revaluation surplus on the disposed assets becomes realized. So who can tell me, how do you transfer it? So we will need to make a transfer to retain earnings because now it's now realized. You can tell me what will debit or credit? If you want to transfer that reserve to retain earnings, how do we do it? Can you guess?
Debit retained earnings and credit income in the POL.
No, far from it. Will debit revaluation reserve because we are moving it away from revaluation reserve, and we'll credit retain earnings because we are taking it to retain earnings. This is how it works. Revaluation reserve is credit, okay? So we debit it. We are taking it away from revaluation reserve, and we are putting it in retain earnings. You see, your exams, I mean, I keep telling my students diet in, diet out, and which we see every diet, they won't really ask you this debit credit thing, okay? We usually do this transfer through statement of changes in equity. I will show you what that looks like. So usually there's a column for evaluation reserve and there's a column for retained earnings. So when that asset is sold, the opening reserve on that disposed asset, you just deduct. It's like you are removing it from that reserve. That okay, it's not a reserve anymore. Now we have earned it. You now go and add it to retained earnings. That's how I need you to really understand it. But the reality is this: you guys, I am training you to be accountants. There's no way you are going to pass through my class that you should not know double entry. Every transaction I'm going to mention in this class, I will be sure I will tell you the double entry. So whether you choose to know it or not now depends on you, because it really might not make you fail. As an accountant, you need to be an expert in double entry. You cannot run away from that, right? So that being said, this is how we transfer that reserves to retained earnings. Okay? Is this clear? If you have any concern, let me know. Any concern? Okay, nobody's talking. Okay, I have a concern, right? I have a concern. My concern is this. Why are we waiting till when we dispose these assets before we are transferring this reserve to retained earnings? Why do you have to wait for so long before we transfer it to retained earnings? I think there's something wrong with that, because if the reserve is huge, that means that particular year, it makes us look as if we have done so well in that year alone. I mean, an earnings that we have made for, maybe we have done this evaluation reserve many years ago, or probably we have been doing it year in, year out. So it has been fluctuating. So how are we choosing a year that we sold to now recognize that reserve as earnings? Is not in tandem with accrual accounting. I mean, there should be a way where this evaluation reserve would be spread over the life of the asset, that we can be recording it into our earnings small, instead of dumping a huge amount in a year to earnings. Are you guys following me? Am I making sense to you? Yeah, Latif, I saw your hand up. You want to ask a question?
Yes, sir.
Okay, good.
Continue, sir.
Okay, good. So there should be a way for us to do that, which is what I wanted to tell you before. I just intentionally hold it on. The standard actually gave us an alternative to this. Now, instead of dumping everything in 1 year, why don't you find a way to spread it? Why don't you find a way to spread it over the period? So usually, we call that excess depreciation. That instead of waiting until you sell the asset before you earn the evaluation surplus, why don't you just do something like evaluation surplus divided by remaining useful life? Whatever you get, you'll just be using that. You'll be recognized, you'll be doing debit evaluation reserve, credit retained earnings, small. Instead of dumping everything in 1 year, why not just spread it over the useful life of the asset? Why not just spread it over the remaining useful life of the asset? Okay, that's what excess depreciation is really talking about. And maybe, but the thing is this, don't ever do this unless the examiner tells you that it's the company's policy to do this. Okay? Unless the examiner tells the company policy to do this. Okay. Now, back to disposal, because what's here is when you dispose an asset in your evaluation reserve. And I said when you dispose an asset, you get a gain or loss on disposal. Remember, I've told you that I will tell you double entry for everything. So let me tell you the double entry for this schedule. Okay, Latif, can go ahead now. We can't hear you.
Yes, sir.
Okay.
Okay, can you hear me, sir?
Yes, please.
Sorry, I want to take you back to that excess depreciation.
Okay.
So I think, is it that you are trying to let us understand that instead of to realize all the revaluation surplus when the asset is being sold, we should have been using excess depreciation to earn it little by little? Is that what you are telling us?
Yes, please. That's what I'm telling you.
Then how do we come about excess depreciation?
Because of your body, Revaluation surplus divided by the remaining useful life.
My own, I have a question too.
Okay.
If we said we have evaluation surplus,
Okay.
like you said, it's not yet earned.
Yeah.
But for the thing earn it, the company can still, go in there and make use of available funds, maybe when there is need for it in the company or something. But if we have started adding evaluation surplus that will not earn little by little to that retained earnings, I'm thinking that might look a bit like we are having I don't know how to put it, like we are having on hand some money that is not available for spending in that retained earnings.
Who says your retained earnings is money that is available? Your retained earnings itself is not money that is available. Accounting is not on cash basis. Profit does not translate to cash. Right? We do accrual basis. Is a promise of cash. The promise of cash. So is whenever it comes in, but we need to ensure that we are recognizing economic activity. As economic activity are happening, we're recognizing it for each year, which is what accrual basis of accounting is actually preaching. Yes, you're making sense, but you're moving it into direction of thinking that retained earnings should be cash. No. Why that evaluation surplus is in OCI in the first place is that the economic activity giving rise to it does not make the income real. It's not a real income because it's an income that tomorrow we can lose. This valuation surplus, we could lose it. The fact that it has gone up this year doesn't mean in the next few months it will not reverse and go down. It can go down actually. So, that's why though we are not enforcing this and saying that this is compulsory, it's an alternative, it's an option that is allowed by IAS 16 if you choose to. If you don't want to choose, because there are a lot of questions around it anyway. If you don't want to choose to do this per annum, then of course, wait until you sell the assets before you transfer the entire reserve to retained earnings. But be ready to answer a lot of questions from your shareholders or reasonable investors that understand reports. Because they will not know why there is a huge swell in your retained earnings in a particular year. So it makes sense to spread it over. Okay. Let's not dwell so much time on this because it's hardly in your exams. It's hardly there. I hardly see it there. So just understand it and know it exists. Now, let me go back to this. Don't let me forget the double entry for when you sell an asset and you're having a gain or loss. There's actually a double entry backing it up. Again, yeah, your exam hardly would ask you this, but know it. All they would need you to know is this debit and credit. I mean, know this also, it gives you more confidence in whatever you're doing. So when you sell an asset, okay, the first thing is you need to remove the asset account. You need to derecognize the asset account from your books. You know, I told you that asset account is always at cost. So you need to remove it. And for you to do that, because asset account will have been debited, to remove it, what do? You credit the assets account. Do you know what you debit? Can tell me? What do you think we should debit?
Disposal account.
Thank you very much. You are taking it to disposal account. For now, it's just like a temporary account because we don't know where else we can put this asset. It's just waiting there. We just take it to disposal account. Waiting. The second thing, after you've cleared off the asset account, in fact, let me note that this is with the cost or fair value of the asset. Just so that you know that asset account is always at cost or fair value, depending on which model you're using, not carrying amount to. The second one is on this same asset, you need to remove the accumulated depreciation on the assets from your books. And how do you remove the accumulated depreciation? Accumulated depreciation is a credit entry. To remove it, you debit the accumulated depreciation account. Do you know what you credit? Disposal account. So with this now, you have removed the accumulated depreciation from your books. It's gone. It's gone. And this is with the accumulated depreciation. If I may ask you, based on these two entries I've passed, what do you think will be the balance? What do we call the balance in my disposal account as of now? What does that balance represent?
Profit or loss.
Earning amount or net book value.
Thank you very much, Abubakar. Because this disposal account, I've already debited it with costs. Now I'm crediting it with accumulated depreciation. Debit costs, credit accumulated depreciation. Cost minus accumulated depreciation is the carrying amount. So what is in my disposal account as of the end of these two entries I've passed is the carrying amount of that asset. What is just waiting for is how much I've sold the asset. So we need to recognize the sales proceeds. Of course, we'll collect money, or maybe we'll collect another asset. They can be exchange of assets. It's not all asset disposal that you actually collect money. You can collect another asset. Yes, you can collect another asset. So you debit that new asset that you're collecting, and of course, you credit your disposal account. With the what? With the sales proceeds. So you see, this schedule I gave you is actually a summary of the disposal account. This gain or loss is determined on your disposal account. Sales proceeds against your carrying amount gives you gain or loss. Because by the time you credit disposal account with the sales proceeds, the balancing figure in that disposal account will be gain or loss on disposal. So these three things it's presumed to have been done before you go ahead with this. But believe me, you need to understand the process. When you sell an asset, you need to take off the asset account from your books. You need to take off the accumulated depreciation of the asset from your books. And the sales proceeds, by the time you match it against the carrying amount, we get gain or loss on disposal. And that's pretty it on derecognition. Finally, if there are no questions, is disclosures. Every standard has disclosure requirements. Every standard has disclosure requirements. So when you understand the standard, you need to a large extent understand what are the items that needs to be disclosed, that needs to be put in the books to enable users understand your financial reports more. And number one is the measurement basis you have used. Have you used a cost model or have you used a evaluation model? You need to tell us. There's no way anybody would know unless you tell us. Now, okay, now we are using cost model. Okay, we have used evaluation model because it's a choice. Number two is the useful life of the assets. You need to tell us. There's no way we can know. Or if you are using depreciation rates, you need to really tell us the depreciation rate of the assets. Also, you need to tell us the depreciation method you chose. You need to tell us, are you using straight line or are you using reducing balance? You don't tell us, there's no way we can know. You also need to tell us the residual value of the asset, because there's no way we would know whether a residual value exists or not if you are not actually telling us. And you need to do a reconciliation between opening and closing carrying amounts, which is the fixed asset schedule that I told you about, which is the fixed asset schedule. That's when you find us doing something like this. Balance brought forward. But they will have costs. We'll now have balance brought forward. We'll have addition. Everything at cost too. We have disposal. If there is revaluation, everything. If there is impairment, if there is business combination, everything, they will just put everything there. Then you have balance carried forward. Then that's for the cost too. All these are disclosures. Then we'll do the same thing for accumulated depreciation. We'll have balance brought forward. We'll have charge for the year, meaning your depreciation charge for the year. We'll have depreciation on the asset disposed. Then balance carried forward. Then you have carrying amounts. For your carrying amount also, you have balance brought forward, which is basically these costs, opening, minus the opening accumulated depreciation. Then you have balance carried forward, which is this costs minus the closing accumulated depreciation. And that's it. So you do a reconciliation that will show all of this. So this is your disclosure requirements. And this is it for all the principles on IAS 16. So let's start solving questions. I'm sure we're going to see some other things that needs to be known. Okay, we still have some minutes to solve questions. So I will really need somebody to read for us. I mean, if you would be kind enough to read for us, would appreciate that. Who wants to do that for us?
Is it this question? Is it this number one question?
Yes, please.
Okay. On 1st
Hello,
of
sir.
October.
Sorry, please. Mr. Asif,
Yes, Abaka.
Okay,
please,
so let
I have a
me
question
read.
concerning.
Okay, Abaka, go ahead.
Okay, so I have a question concerning this transfer of the surplus from evaluation surplus to retained earnings.
On
Okay.
on 1st October 2026.
Yes, Abaka.
Okay.
We can't hear you now. Let's take it one after the other. Abubakar, ask your question, then after you, we'll take Joy. Yeah, continue, please.
Okay, sir. So we are transferring the amount because we sold the assets, which makes it a realized earnings. So if it's going to retained earnings, I feel like retained earnings is not. I feel it should go to profit or loss account.
Okay, why?
Because for the assets that was not where they did not do evaluation that we mentioned earlier, the gain would go to profit or loss account.
Fantastic. Good reasoning, right? Good reasoning. So two things. Number one, so IAS 1 and IAS 16 specifically mentioned that we should take it to retained earnings to avoid unnecessary issues. And more or less, again, most items in retained earnings will end up in, most items in P&L, any profit you did not distribute ends up in retained earnings. Okay? So it would ultimately still go to retained earnings. But the standard specifically mentioned that when evaluation reserve becomes realized, you take it to retained earnings. So, but good question. Joy, over to you. Okay. The person reading for us, please, let's continue reading, please.
Is this question that we want to solve, where can we find it on back?
I don't know. We will check that later. You can see it on the board here for now. Please, let's concentrate on the board. Oh, yeah.
Okay. On
20x6.
of October 2006, Omega began the construction of a new factory. Costs relating to the factory incurred is in the year ended 30th September 2007 as follows. Purchase of land, 10,000. Cost of dismantling existing structure on the site, 500. Purchase of material to construct the factory, 6,000. Employee benefit cost, under note 1, is 1,800. Production overhead directly related to the construction, under note 2, 1,200. Allocated general administrative overhead, 600. Architect fee directly related to the construction is 400. Cost of relocating staff who will work at the new factory is 300. Cost relating to the former opening of the factory is 200. Loan interest under note 3 is 1,002. Then note 1. The factory was constructed in the 8th month ended 31st May 2007. It was brought into use on 30th of June 2007. The employee benefit costs are for the 9 months to 30th of June 2007. Note 2. The production overhead were incurred in the 8 months ended 31st May 2007. This includes an abnormal cost of 200,000, which was incurred due to the need to rectify damage resulting from a gas leak. Note 3. Omega Co. took out a loan of 12 million on 1st of October 2006 to partly fund the construction of the factory. The loan carries a rate of interest of 10% per annum. Note 4. The factory has an expected useful life of 20 years. At the time, the factory was, at that time, the factory will be demolished and the site restored to its original conditions. The restoration is a legal obligation that arose on signing the contract to purchase the land. The expected cost of fulfilling this obligation are 2 million. An appropriate discount rate is 8%, which represents a discount factor of 0.215 for the 20 years period. You are required. Please help me to scroll up, sir. Okay, you are required. Calculate the initial cost of the factory.
Your name is Femi, Abi?
Yes, thank you.
Thank you very much. I appreciate. You'll be reading for me in this class. People that read for me don't fail, they pass. Okay. So we are asked to determine the initial costs. This is like the first thing I taught you under measurement, initial measurement. When we were talking about purchase price, import duties, non-refundable purchase taxes, less discount and rebates, and all of that. So this is a question on that. So it gave us quite a lot of details. And we are asked to calculate initial cost. So we need to take it one by one. So we'll follow through with the question. So solution. So let's pick it one by one because we are talking about October 1st. So this guy is constructing a new factory. And they say the cost relating to the factory incurred for the year ended 30th September 2007. That's at the end of that year. We as follows. So basically, we need to go through this cost and know which one are we adding as part of the cost of the assets and which one are we supposed to expense. Meaning we cannot add it as part of the cost, probably would expense it, right? So the first one is the purchase of the land. Should that be capitalized?
Yes, sir.
Yes, sir.
Yes, sir.
Okay.
It should be capitalized.
It should be capitalized. Okay. So determination of initial costs. So as we are deciding it, we can be putting it there. So we said purchase of land. How much was it?
10,000 naira.
We said it should be capitalized. The next one is cost of dismantling existing structure on the site. What do we do to this?
It should be capitalized, but
It should be capitalized, sir. It's a part of site preparation.
Yes. I fully agree with that. So cost of dismantling existing structure should be capitalized because it's like site preparation costs, like directly attributable costs. So let me take it there. But Femi, you were trying to say something.
Yes, that's what I wanted to say.
Okay, what's that? What do you want to say?
That it should be capitalized because you have to prepare the place before you.
Okay. All right. The next one is purchase of materials to construct the factory. Are we capitalizing this?
Capitalize, sir.
Yeah, capitalize it. 6,000. The next one is employee benefit, but they said there's a note on that. So there's a note 1, Abi.
Yes, sir.
What's the note 1 talking about? It said the factory was constructed in the 8 months ended 31st May 2007. It was brought into use on 30th June 2007. The employee benefit costs are for 9 months to 30th June 2007. Okay. The factory was constructed 8 months ended. Okay, it was brought into use in June. The employee benefit costs are for 9 months to June. So meaning that this employee benefit cost they gave us is for 9 months. And the construction really took 8 months. So what are they saying there?
We make 7/9 multiplied by the amount.
7/9? Why 7/9?
It means that part of the employee benefit was not specifically for.
I'm asking, how did you get 7/9? Is it
For
7/9 or 8/9?
8/9, I'm sorry, sir. 8/9.
Okay.
Thank you.
Yeah, because the construction took 8 months, right? And they gave us employee benefit of 9 months. The one we should capitalize is the one that is directly attributable to the construction, which is the 8 months period. That is when we capitalize. So employee benefits. That's 8/9 multiplied by what? 1/8. So how much does that give us? 1,600. Okay. The next one is production overhead, directly related to construction. There's a note to that, note 2. He said production overhead were incurred in the 8 months ended 31st March 2007. This includes an abnormal cost of 200, which was incurred due to need to rectify damage resulting from a gas leak. Okay, so wastages are not capitalized. So this 200,000 abnormal cost is like wastage. Is an abnormal cost. You don't capitalize that. Ordinarily, this production overhead should be capitalized because they told us that it's directly related to construction. But for the fact that there is a 200 inside that is an abnormal cost, we need to remove that. So our production overhead would be 1,200 minus what? So we'll be left with 1,000. That's the production overhead. So allocated general overhead, general admin overhead. What do we do to this? Are we capitalizing or expensing this?
Expense.
Expense any general overhead.
Exactly. You
Just
expense
specific.
it. Just expense it. Don't even think it twice. Then we have architect fees directly related to the construction. What do we do to this?
Capitalize.
Correct. We capitalize this. How much is it? 400.
A second.
400. What's the next one?
Cost of relocating staff.
What do we do to this?
It should be a capitalized, I say, directly attributable cost.
Okay. Let me show you. I think I
Not
thought
capitalized.
should be expense now.
It should be expensed.
Exactly. See, relocation costs. The following costs are not directly attributable.
Yes, sir.
relocation cost. So it should be expensed. It should be expensed. Cost of relocating staff, expense. So we won't include that. What about costs relating to formal opening of the factory?
That is expense. It is not even
Expense.
attributable.
It's
Exactly.
ceremonial.
Exactly. What about loan interest? They give us a note on that.
Capitalized.
Yeah, depends. So they said Omega took a loan of 12 million on 1st October to partly fund the construction of the factory. The loan carries a rate of interest of 10% per annum. So usually borrowing costs for qualifying asset, like this asset now that you are constructing yourself, we capitalize the interest, we capitalize the borrowing cost. But the interest you capitalize the interest you incur to the date when the asset is ready or when construction is completed. So in this case now, this interest of 12 million we are paying interest of 10% per annum, which of course is this 1.2 million they got. 10% times 12 million was a 1.2 million. But the 1.2 million is for a whole year. Remember, the construction only took how many months?
8 months.
8 months.
So we need to only capitalize 8 months borrowing costs. So borrowing costs is 8 over 12 times what? 1,200. How much is that?
800.
800.
800. Okay. And that's all for this. And there's a note 4. There's a note 4 here. They said the factory has an expected life of 20 years. At that time, the factory will be demolished, the site restored to its original condition. This restoration is a legal obligation that arose on signing the contract to purchase the land. The expected cost of fulfilling this obligation is 2 million. An appropriate discount rate is 8%, which represents a discount factor of 0.215 for the 20 years period. What's this talking about?
We have to discount the dismantling restoration cost to the present value. Then we'll capitalize it.
Fantastic. That's absolutely correct. So we usually capitalize the initial estimate of removal, dismantling, like that. So as I have mentioned, this dismantling cost needs to be capitalized. We cannot capitalize the 2 million because it's a future value. So we need to discount it to present value. The examiner gave us a discount factor of 0.215. So I just multiply them together. So how much does that give us? Can you punch your calculator? You know, your calculator has to be beside you anytime you have my class.
430, sir.
430. Good. So can you sum everything together?
15,330.
Sorry?
15,330.
Like this.
Yes,
Okay.
sir.
All right. And I can say for sure that this figure is wrong.
Sir, it's wrong. It's wrong.
20,730.
It's 20,730.
2730.
2730, sir.
Okay. I know that voice. It's used to giving wrong figures. Okay, that's the end of this question. Let's go to question 2. Another question. Femiria. Where's my reader now? Where's Femi?
I'm here, sir. Okay. An item
Yeah.
of plant, okay. An item of plant was acquired for 220,000 on 1st of January 2006. The estimated useful life of the plant was 5 years, and the estimated residual value was 20,000 naira. The asset is depreciated on a straight line basis. On 31st December 2006, the remaining useful life of the plant was estimated to be 3 years with an estimated residual value of 12,000 naira. You are required. Explain how depreciation would be calculated for the plant for each year of its useful life.
Okay, good. So we have a plant that was acquired for 220,000 on this date. Useful life is 5 years, residual value is 20 years. And they use straight line method of depreciation. Fine. At the end of the year, the useful life was revised to be 3 years. And they revised the residual value also to 12,000. Then I said explain how depreciation will be calculated for the plants for each life of the assets. So how do we determine the depreciation? First, at the end of the year, 31st December 2000 and what? 2006, which is like year one. Which is like year one because we bought the asset for that year. So at the end of the year, using straight line method, my depreciation per annum. Joseph, mute yourself. My depreciation per annum will simply be costs minus what?
Residual value.
Divided by what?
Useful life.
Useful life.
Life.
Estimated useful life. What's the cost?
220,000.
220,000.
What's the residual value?
20,000.
20,000.
Okay.
20,000. What's the useful life?
Yes.
5 years.
So what's our depreciation?
40,000, sir.
40,000 per annum.
Yes.
However, after doing this now, they now came and say that we are revising the remaining useful life. From the end of this year, we are revising it now to 3 years. What should be, the remaining useful life should have been 4 years, Abi? But now they say they are revising it to 3 years. And also, they are revising the residual value to 12,000. No problem. We are cool with that. First, at the end of this year one, I need to know that my carrying amount, how much will my carrying amount be?
220 minus.
What will be my carrying amount?
180.
How much?
180.
180,000.
Okay.
1,000.
Okay. Correct. Which is
180,000.
Yeah, that's correct. Which is 220 minus 40, and that's 180. Now, since they have changed a lot of things, that means from next year, from 31st December 2007, which is year two.
Year two.
Ordinarily, you know that if they were using straight line method, depreciation per annum should just be 40,000 every year. It should not change. But now they have changed useful life. They have changed residual value. So my depreciation, I have to recalculate it. my depreciation per annum going forward is now be the new value of that asset as at that date, which is the carrying amount, minus the residual value divided by the remaining useful life now, because a lot of things have changed. So the carrying amount as at the beginning was 180, this 180, minus the revised residual value, which is how much?
12,000.
12,000 divided by the revised useful life.
3 years.
Which is 3 years. So how much do we have?
56,000.
56,000.
Like this.
Yes, sir.
Yes, sir.
No.
So that means my depreciation per annum going forward now is how much? 56,000. So what's my carrying amount?
56,000 with 3 zeros, sir.
Okay,
Please
with
check
3
the
zeros.
56,000. Yes.
Thank you. So what's that my carrying amount now?
124,000.
How did you get that?
The 180 minus 56.
How much is that?
124,000. 124. 124.
124,000. What's the alternative way of getting this 124,000? This is correct. You're absolutely correct, right? But there's an alternative way. If I want to follow through with the formula I actually gave you for determining carrying amount, which is cost minus accumulated depreciation. And that will be 220, which is cost, minus accumulated depreciation. Accumulated depreciation is 20 plus 56. So which is 96. If you do 220 minus 96, what would I give you?
One, two,
Oh,
four, sir.
124.
Okay, this the same thing, right? So just know that. So that means in year 3 now, just want to confirm, what will be my carrying amount in year 3? I know my depreciation in year 3 will be how much? Let me even be sure that you will know that one. What's my depreciation in year 3?
56,000.
Thank you very much. It's now 50 because it's from year 2 now, it's 56,000 per annum. So my carrying amount can just be 124, Abi, minus what? 56. Abi?
Yes, sir.
So which is how much?
68,000.
68,000. Okay. This question, you should have stopped in year 2. That's what they want us to do. From year 2, just stop. Okay, let's go to another question. Yeah, Femi, read please.
Okay, sir. On 1st of January 2002, an entity purchased a furnace for 200,000 naira. The estimated useful life of the furnace was 10 years, but its lining need to be replaced every 5 years. The cost of the lining at 1st of January 2002 was 50,000 naira. The lining was replaced on 1st of January 2007 at a cost of 70,000 naira. You are required to calculate the annual depreciation expense relating to the furnace for each year of the useful life. That's the question.
Okay, thank you very much, Femi. So if you look at this question, it says on 4th January 2002, an entity purchased a furnace for 200K. The useful life of the furnace is 10 years. but its lining needs to be replaced every 5 years. So the cost of the lining as of 4th January is actually 50,000. So the lining was replaced in 2007 at the cost of 70K. So calculate another depreciation expense relating to the furnace for each of. Okay, good. So now, a question like this is a question where an asset has different components. When an asset has different components, and each component has different useful life, so you are expected to depreciate each component separately because they have different useful life. So there's no way you can combine their depreciation since their useful life are actually separate. And that's the scenario here. So there's a furnace, right? And whatever that is, 200. And that furnace itself has 10 years. But within that furnace, there's something called lining, which now has its own useful life of 5 years. And the cost of the lining is 50K. That means the other part of the furnace is 150K. The entire furnace is 200K. There's a lining within that furnace whose cost is 50K. That means the other part is 150K. The lining has a useful life of 5 years. The other part has a useful life of 10 years. You can't depreciate them together. You depreciate them separately. So from 2002 December, meaning from year 1 to, in fact, from year 1, my depreciation you do for the furnace, which is 150K, divided by how many years? 10,000. That'll give me depreciation of 15,000. For the lining, that'll be 50,000 divided by what?
5
5.
years.
And that's how much? That's 10,000. So, as far as the lining is concerned, from year 1 to year 5, the carrying amount of the lining becomes what?
40,000.
0. From year 1 to year 5 now. Or let me say at the end of year 5.
That's 40,000.
The carrying amount of the lining becomes how much? Becomes 0 because we are charging 10,000 depreciation every year. Year 1, 10,000, in year 2, 10,000, in year 3, 10,000, like that. So at the end of year 4, we will have charged, our accumulated depreciation will be 50,000. And the cost is how much? 50,000. So the carrying amount becomes 0. So from year 6 going forward, which will be 31st December 2007, because year 1 is 2002. So 2, 3, 4, 5, 6, 5 years. Now, they replace the lining at a cost of how much? 70,000. Okay? So depreciation from year 6 now, for the furnace, how much will be our depreciation for the furnace? You can tell me? Okay, what about for the lining?
14,000.
Sorry? How much for the furnace?
That's 200,000 minus 70,000.
No. It still remains 15,000.
14,000.
For the furnace remains 15,000. Yeah. It won't change. This one does not change. It's a straight line method of depreciation.
To still be you.
Sorry?
You see the 150,000.
I can't hear you. Joy, I can't hear you. Joy, I cannot hear you. Your network is breaking. Or can anybody hear us? So I can know what our question is. So for the furnace is 15,000 per annum for the next 10 years. For the lining, 10,000 for the next 5 years. So after 5 years, the carrying amount of the lining becomes zero. So lining is starting over again. But furnace in the 6th year, because it's like year 6. So in year 6, this furnace is still 15,000 per annum every year. The lining is now 70,000 divided by what?
5.
Thank you very much. Divided by 5. Thank you. So how much would that give us?
14,000.
14,000. That's correct. So if I may ask, what will be the depreciation of the lining in year 7?
Still 14,000.
14,000.
Thank you very much. 14 for the next 5 years. So if I may ask again, for this furnace, what's the carrying amount of this furnace in year 6?
That would be 70,000 minus 15,000.
No, Abosede.
In year 6, that's 75,000 minus 150.
Okay, how did you get that?
Since it's 15 years per annum, that's 15 times 5 for the 5 years. That's 75 then minus 150.
So it's 15 times 6. So we are talking about year
Okay,
6.
6 years. Oh, sorry, sir. That's 15 times 6 minus 150.
So how much is that?
110,000.
That would be 40,000. Now, which one is 110? What's 15 times 6?
That's 90,000.
90 minus 150. That's 60.
60,000.
Okay, good.
That's
Nice
60,000.
one, Femi. Very nice one.
Thank you, sir.
Very nice one. Okay. So that's it about this question. It's a reasonable question. Let's solve this one. This is a past question. Yeah, let's read. This will be our last question for today. When is your next class?
Tomorrow.
No, not for me. The next class after now.
Okay.
PM. I think FM.
FM.
That should be
I can't finish this question, so I will just do only determination of machine costs. I'll do this remaining 2 tomorrow. Then we'll continue solving our questions tomorrow. We have plenty of questions to solve. And we have to finish everything just for you to get used to it. Yeah, please, Femi, let's read again, please.
Officer.
Can I ask a question before you proceed, sir?
Okay.
What do you say?
Can I ask a question before he proceeds with the...
Oh, yes. Oh, yes.
Okay. So, if a vehicle was purchased and in the course of when the vehicle was delivered, the engine was damaged, like the engine got knocked, and a replacement was now procured a replacement for the engine. So that engine that was procured now, the replacement now, what treatment is that supposed to happen to that one? Is it supposed to be capitalized or expense?
You know the answer. You tell me. Because the answer is very clear. What do you think?
Capitalized?
That's correct.
Okay.
Capitalized. Capitalize it. Is replacements. Most replacements you capitalize them. Most replacements you capitalize them. Good question.
Okay, so also, what happened to the engine that was damaged? How do we now, cater for that? Should I say loss or what? Or should we just use this as a sort of replacement? Because the new engine now obviously now increase the cost of the assets of the vehicle.
Yeah, so it depends. It depends really. It depends really. Ordinarily, you just do nothing.
Okay.
In the example you have given me, you do nothing. The replaced engine is replaced, and that's it. If it's an asset that is componentized, that you know the cost of each component,
right?
Each component have like different useful life. So the right thing will have been you derecognize, you remove that one from our books. You derecognize that, then you add the new one. But in this scenario, we don't even know how much cost separately. So that will not be. So I mean, there's a lot to it really, which you are going to learn for asset like this. Because a reasonable person will say, then you're overvaluing the cost because the existing cost includes the cost of the engine. You now put another one, you're now adding that again. Okay, so there's something we call impairment of assets, right? As soon as an asset is damaged, IAS 36 says you need to impair that asset immediately. You need to bring it down to its recoverable amount. So you would have actually done a kind of an impairment loss on the assets to get a new recoverable amount. Then on that basis, you'll be having a value that shows the actual worth of the asset, where you're not overvaluing your asset. But we'll get there.
Okay.
Yeah.
All right. Thank you. Thank you.
Yeah. Thank you very much for that question. So we have 6 minutes to go. So let's just stop for here today because the reading of the question itself will take 6 minutes, and I don't like spending beyond my time. I'll see you guys next week. Have a wonderful time until tomorrow. Should I give you any assignment?
No. Yes, sir. We appreciate that.
Give us something to play with.
Give us something, sir, to hold on.
Okay, go and solve this. Go and solve this question.
No.
Yes, go and solve it.
Okay, how are we going to get the question, sir?
It's in the note, though. All these questions I'm solving in your handout. I just extracted it here for you.
Okay.
So solve it. Send it to me before tomorrow. Those of you that are not in my assignment, if you think I don't know you, I know all of you, and very soon I'll start getting you. I'll see you tomorrow. Bye.
Good night.
All right. Thank you, sir. Bye, sir.
Thank you, sir.
Thank